Welcome to Next. I'm your host, Michael Sonnenfeldt, founder of Tiger 21. Shane Neman is a serial entrepreneur, family office investor, venture capitalist, and the author of Nightlife Lessons. First of all, welcome to the show.
Well, thank you so much for having me, and thank you for that kind introduction. It's really flattering to hear what you said about being a successful investor. I find that to be my career right now, just trying not to be bad at investing. That's what I've been trying to do for 13 years, and I'm still trying to do.
Let's go back to the beginning a little, because I happen to be of the belief that origin stories make a difference. Most Tiger level entrepreneurs had challenges in their youth, and part of the reason they're so successful is they spent their first 20 years saying, I'm going to prove to the world that I'm better than the world might see me. You have a unique story. Your parents came to America as refugees from Iran. Talk a little bit about how growing up in that household might have shaped you in terms of both personality and particular ambition and maybe entrepreneurship.
Well, it absolutely did affect me. I think that you're correct. Adversity does two things to people. It's pretty binary. Either it dejects you or it makes the driver behind you. And for me, that was definitely the case. My parents came in the late 1970s. They were established, upper middle class. My father was an architect. My mother was a housewife, but she kind of taught English on the side. Classic immigrant story. They had to leave everything. They left the car at the airport, came with a few $1,000s in their pocket, and had to literally start over. My father couldn't become an architect. Going back to school to do that was just not financially viable for them to do that. They had to reinvent themselves. That's the constant, is constantly having to reinvent yourself, and that not being optional for you, right? You take your circumstances and you make the best out of it and you play by the new rules. That's something that I really learned from them. They came here with nothing. My father pivoted to the clothing business because he could use his design skills to do that. They were very entrepreneurial, started designing his own clothing. They built a whole factory kind of thing in the basement, and they would work till 3 a.m. And I would fall asleep watching them on a table or, on the floor in the basement. And that was the work ethic that I was taught. My father ended up passing when I was 13. He was very young. He was 44. Another adversity happened to us, specifically to my mother. Become a single parent at that point with a 13-year-old boy and not knowing how to run the business because she, although she worked in the business, she didn't know how to design clothing. And so she had to reinvent herself as well and get back on her feet again. She had very, very poor health. And despite that, she never complained, picked up the pieces and built her, a real estate career, got me through college, actually.
So let me interrupt there, because it's obviously a heart-wrenching and inspiring story at the same time. But were you compelled to do something differently because you learned from your parents what not to do? Or is the example that they set so powerful of just working hard and doing what you have to do and being flexible? Were you more duplicating something that you found from them, or more running to do something different because you learned something from that experience?
I think it's a little bit of both, to tell you the truth. They had been through a lot, so they were more conservative than I am, I would say now. The thing that I learned the most is, the world just doesn't work the way it should always work, and no one owes you anything. You have to kind of fight to make your way. There's no substitute for hard work. You just have to be adaptable.
Did you have any mentors, not your parents, but did you learn about anybody, friends of your parents, other adults? Were there any people whose life you, for lack of a better word, envied and said, that's what I want, I got to figure out how to get that? Do you have any memory of that?
My biggest teachers, I would say, and why I decided to write a book about it, was the entire nightlife industry. I ended up building a software company that served that industry. And I really learned the most I've ever learned about human nature, human psychology, marketing, and business from all that entire ecosystem, whether it was from club owners, promoters, ticket sellers, the alcohol industry. It taught me things that you would never ever learn in college or with an MBA degree. I think building scarcity is one of the things that they do in the nightlife business, and they artificially build that. And learning how to do that effectively is very difficult, and creating demand. When you're selling them, if you ever looked at a nightclub when the lights are on, the place is a dump, right? But if you turn off the lights and put some lasers on and put a few cool people inside and put a doorman there and create this facade of the velvet rope, you could sell a thin air to people. That's actually one of the biggest lessons that I learned.
You had a first company which failed. Talk a little bit about that and what did you learn from that?
We built basically what would be considered Microsoft 365 right now, where you would log into a portal, you would get your apps. In that day and age, the apps were Windows based. They were not, web based. It was great, beautiful software that we built over 2 years, but no one used it because it was way too early for its time. Just even the permeation of high speed internet hadn't existed at that point. So suffice to say, we went down with the dot-com bust and we were just too early. So sometimes you can have the best idea and the correct idea, but if you're too early, it just doesn't work.
What was the one or two most important lessons you learned in that failure that might have guided your future successes?
Well, I can tell you the first thing that I did when I started my next venture was making sure that I get profitable as soon as possible and
Mhm.
making money. Well, my next two were not venture backed. So I didn't want to take venture money again. It was, really awful losing other people's money. And I don't really want to deal with that again. I lost my own money too, all of it actually. That feeling of being broke, I never wanted that again. That was really the driving force behind my next ventures. And also being very cognizant of whether what I am doing right now would be adopted or not and would be needed and can actually be used.
Your first venture after the failure was Junebug, which
Yeah.
obviously was very successful. Give sort of a snapshot of Junebug.
I kind of got to understand the nightclub and bar business and realized that it was really backwards. I had an in into the industry because my girlfriend at the time was working part-time doing that while she was going to school, and built the first kind of software system. We built a marketing stack. We also built one of the first ticketing systems that, sold tickets for venues under 5,000 people, which was overlooked as well. That ended up growing into a really big business because there was a lot of demand for it and no one was serving them.
What forced you or what brought you to the sale of Junebug? You had this amazing success and tens of millions of dollars of revenue. I assume it
Yeah,
was quite profitable. How old were you at the time you sold?
let's say 32 or 33 years old.
With the benefit of now hindsight, do you think you made the right decision?
Oh, I absolutely made the right decision. I was at a point in my life, we had a very large business, very hard to have a personal life that was meaningful, hard to get married to the, at least to the type of woman that I wanted to get married to that would want me around a lot more, just as a practical matter. But more importantly, what happened was I had started another company called Easy Texting about 2 years prior to selling the company. And we realized that the efficiency of email marketing had declined a lot. And so I built a text messaging system. From what I understand, it was the first platform in the United States. And then, Twilio came along 3 or 4 years later. We built this kind of like, let's say, MailChimp for text messaging system called Easy Texting. That was the shiny new object. I realized that I could scale that business much bigger than Junebug. We leveraged Junebug to sell into the nightclubs, but then just weirdly, Our next biggest client were churches, which just doesn't make a lot of sense.
Well,
But
for those who remember, did you have the Limelight as a client? Because that's a nightclub and a church.
we actually did. The name of it was something different at that time. But yes, it's actually now it's a mall.
I think I'm dating myself here.
That was a long time ago. I went there a long time ago when I was in high
So
school.
you were in something like year 8 for Junebug. You start easy texting. Now it's 2 years later. What was your thinking about selling Junebug and riding the easy texting wave?
I really kind of came to the conclusion that, first of all, I couldn't work that much anymore. I was exhausted. We always had a competitor that was nipping at our heels. So I saw an opportunity to exit that business cleanly and then just spend all of my time on easy texting, which, quite frankly, I was enjoying a lot more because it was a lot more structured. We were just a software company.
How many years after you sold Junebug did you sell easy texting?
That was another eight or 9 years.
So you really had a long run on that. One of the things that I've observed over the years is a phenomenon. I ask a Tiger member, which is more valuable, your time or your money? Of course, when somebody's asked explicitly, if they've had a great deal of success, and maybe not even, they always say, "Oh, my time." But people don't behave that way. You hear these crazy stories of people flying to California, but they stopped in Milwaukee because they could save a couple $100 on the ticket, or they drive across the state line to get, in the old days, cigarettes or cheaper gasoline, or they don't go see their children for a birthday party or their grandchildren because it would take 9 hours to get there. But if they were in a financial position to charter a plane and they said, my time is more valuable than my money, they might get there in a half an hour by a chartered plane. So it's an interesting phenomenon because people are shocked by the number I'm going to give you. Observationally, a guru could realize his or her time is worth more than their money, and they could have no money, but they still have a mindset. But normally it takes, in this society, tens and tens of millions of dollars to allow someone to perhaps grow into the notion of their time is more valuable than their money.
Earlier in our conversation, when I was talking to you about my parents, right? My parents valued money, rightfully so, because they went through a lot of adversity more than their time. So they were in a kind of scarcity mindset. That's one of the things that I'm very cognizant of. And by the way, I'm guilty of it sometimes. It's something that I learned, and I have to kind of shift into this abundance, mindset where you're really kind of using money to optimize your time. Basically.
Sometimes people talk about it as a flow, money as a flow. If you have money coming in and money going out, as long as the flow is in the right direction, you can free yourself. But I want to go back to the first and then the second company. You bootstrapped both of them. You didn't take in any venture capital. And I was just talking to a younger colleague of mine who's trying to start a business, and he's wrestling with whether he should try and raise $500,000 so that he has the capital to operate the business, but he might have to give away 20 or 30 or 40% of the business to get that, or whether he should bootstrap it with his savings, which feels a little risky, but then if it's a successful idea, he won't have any capital partners that, let's say, provide a distraction. And if he had come to you, do you have kind of black and white views on that?
I do. It's actually contrarian to what I do. I tell every founder, to the degree that you can not have investors, you shouldn't. That's just a fact. You should own the majority of what you're working for if you can, and if you're able to. You can be scrappy enough to do it, or you have the talent enough to do it, or I don't know. It's very different for every business. Some businesses really require CapEx, so you may not have a choice. But to the degree that you have a choice, you should always try not to have an investor, because regardless of how good the investors are, or big names they are, or whatever, you're one of many to them. Okay. And they're not going to necessarily, unless you're like, win the lotto and you become their favorite or something, which is very slim to none chances, you're not going to get the kind of value that you think from any investor other than the money that they give you.
I don't want to leave your easy text in the lurch, because you went 8 more years. And when you sold Easy Text, you had an episode before you sold it with one of the big mobile operators. Can you talk about that, and what was the lesson that was learned?
Oh, well, it was an existential moment for me, actually. T-Mobile, we had a client that was a service that would kind of tell you where the weed dispensaries were in California. It's called Weed Maps. And that's all it did, was just kind of tell you where the dispensaries were. And they were using our text messaging platform. And I guess T-Mobile realized this and, shut off our access to the T-Mobile network. So it was really a do or die moment for us. And I had to claw my way, hire a law firm that I could never afford, thinking that I'd finance it at some point. Started doing my own PR campaign. And then eventually we filed an emergency injunction. I had to go to court. Eventually they shut us back on. That was like a 2-month process, 3-month process. And it cost me an arm and a leg and set us back. But I survived. And there were many, many nights, sleepless nights during those 3 months where I kind of was at an end of my rope. That night, I decided that was the end. I was going to shut it off and just move. And then in the morning, I just reinvigorated and kept fighting, And I think that's what a lot of startup is being in this mental state that is really uncomfortable, constantly on edge and afraid of losing everything.
It's not for the faint of heart. When you exited Easy Text, was that more or less successful than Junebug?
It was more successful for us. The
Yep.
multiples for like events-based businesses and stuff were much less than SaaS at that time. So,
And you felt validated by having made that decision.
I was happy.
We're about to get into Shane's transition from entrepreneur to investor. But before that, we're going to introduce an organization we've been supporting this season through our giving moment. At Tiger 21, we talk a lot about how many successful entrepreneurs just think differently. It's basically their superpower, but it definitely comes with its own set of challenges. Isaac, can you tell us more about the organization and what makes them so special?
Sure. Understood.org helps millions of people with learning and thinking differences like ADHD and dyslexia unlock their full potential. They have resources for everything from navigating office life and school to relationships and just getting through the day. It's all about helping people learn what their strengths are and how to get where they want to go.
For this season of Next, we'll match donations up to $10,000 per show and up to $100 per individual gift to understood.org. If you want to support, head over to understood.org to learn more, and muse.com/giving. That's MUUS as in Sam.com/giving to donate. We've also dropped a link in the episode notes to make it super easy. Now back to the conversation. You've now flipped the ticket. You're an investor investing in entrepreneurial startups and trying to convince the entrepreneur why they should accept you as an investor.
Sure.
And so you have a sense of how you can add the most value. And what is it that you hope entrepreneurs see in your involvement that makes them feel like the exact opposite of the advice you were just giving, that you become the indispensable partner?
You really don't want investors that are too intrusive. One of the themes that I have is that if I'm investing in you, I don't want to have to help you. That's not the point of me investing. The point of me investing is investing in someone who's better at me than almost anything. And I'm happy to help to the degree that the founder wants my help. I don't want to invest in someone that I have to constantly help. You want your money to work for you, not to work. That's the point of investing. People lose sight of that. A lot of people want control and these other things or board seats and things of that nature, which I really don't ever want. What's also interesting is it's like investors want to invest in people who don't need their money, which is also really totally contradictory in itself, right? They want to invest in the best deals where they're oversubscribed and all that kind of stuff, right? It's hard to stand out. I think for me, what's really worked is my network. So sometimes, I'm not just investing with my own capital, I'm pooling capital with other high net worth entrepreneurs or family offices. There's been a lot of value in that network in terms of being able to become, for example, a customer of the company or referring customers or being a vendor, that type of thing.
I run a venture capital firm focused on climate, although now it's just been incorporated into our family office business. So it's really a portfolio of 35 investments. One of the principals who joined our firm a few years ago, we were telling her how engaged we were with many of our companies because we really wanted to be a value added investor. And she said, if you spent more time before you invest picking the right companies, you might have to spend less time after you invest trying to fix them. Clearly, there's two ends of the spectrum because if you take Peter Thiel's venture capital firm, they are, I think, the most hands off, or at least by reputation. But there are some venture capital firms that really add value. The question is, when those venture capital firms are adding value, is it a good use of their time, or could they have invested the capital more wisely and more efficiently without having to get so involved in the companies they invest in?
Some of the VC firms, they've gotten so big and they have so much AUM and they have so much capital deployed that they have to create like these incubator systems and things of that nature. To spur formation of these types of companies that they want, and B, to attract the companies that they want. It's almost like a marketing system for them to get more.
They're asset aggregators.
Yes, exactly. So their methodology is very different than what I do. I also don't have an actively managed fund, right? I'm only going into certain high conviction companies, which I may have many of them in one year. I may have many years where there's none of them. And that's a very different model.
You and I got to know each other a little closer in preparing for this. And we have so many overlapping themes in our career, other than the fact that I'm 20 years older than you, if I may say that. But the thing that really struck me is I was mentioning this colleague of mine who's thinking about starting a business. He called one of my friends who is a former very senior officer at one of the big investment banks in New York. And although he thinks of himself as an entrepreneur, this friend of mine really was an investment banker and then a fundraiser. So when he was giving advice to this young man, he said, "Oh, you have to go raise a fund and then that'll fund your operations." And I was saying, "You're much better off bootstrapping without other people's money, because if your idea is successful, you'll have much more latitude about how to operate and change." And it was so interesting to me because there's lots of ways to be successful. I think you've been pretty clear that you're closer to the bootstrapping side than go raising the capital. But this is an amazingly successful friend. It's just he got to his success on a different path. His skills is he's the most consummate collector of people that I know. He knows how to work a crowd both literally and figuratively. I suspect you and I are more, maybe not introverted, but the critical path to our success wasn't having the biggest Rolodex in the world, but it was having an idea and figuring out how to plant the seed and have it come out of the ground.
Yeah, well, I can tell you your friend is AI proof because I think that's the only thing that's going to kind of stand out in a world where, a lot of the things that we're talking about are kind of become obsolete, I would imagine. Having a personality, knowing how to relate to people, being likable, just being likable is very difficult to do.
Interesting. I don't think my parents ever taught me to be likable, and some people would confirm that for you. But
I like you. That's okay.
you've increased the value of your wealth many times since you sold, which makes you the even more rare entrepreneur that can pivot. Now, you were a high tech entrepreneur, and therefore you probably had a better understanding of the companies that you were investing in. But it's still really remarkable. And what that allows you to do is create a what you call a barbell thesis, where you have deep tech on one end and physical products, services, and spaces, real estate, et cetera, on the other. Talk a little bit about that logic. But what's really interesting before you do is where are your safe assets? Like, how do you, if you're just in deep tech in one end and you're invested in real estate and other things on the other, what do you do for a rainy day?
I don't think I'm reckless. Let's just put it that way. I'm not saying for people to be reckless. And by the way, I think part of the reason why I was able to grow my assets is that because I saw it as my business and my job to manage these assets, right? And manage my family office and that kind of thing. In the same way that I built easy texting and those types of things, I implemented the same kinds of things, and I brought together people who were willing to teach me and I could learn from. And that meant going through a lot of wealth managers, a lot of lawyers and accountants until I found the right ones. You have to have the drive to do that. And if you don't, you won't do it, right? If you treat it just like your previous business, the chances of you, growing it is much higher. I'm not reckless. I have enough cash, to survive a couple of years of a downturn kind of situation, which I always do. I'm not saying for you to, have no cash or that kind of thing. Like every other family office, I have an allocation to asset classes like real estate, which are cash flowing.
Tiger members, particularly former entrepreneurs, there's part of a theme that you're reflecting because, as a general rule, we have what I would call a risk-on portfolio, meaning
It is risk on.
Today we have just between private equity, public equity, and real estate, almost 80% of our portfolios, which is a much higher risk-on portfolio than would be a traditional family office. And I think what happens is there's an anomaly because people think of family offices as investors. And that might be true when, like you're the founder and you're now running a family office. But by the time second generation comes to take over, they're not going to have an 80% risk on portfolio because it's too risky for their perception, given how most children grow into wanting to be less risky. That's one of the things that's interesting. Second generation kids aren't less ambitious. They're just less attracted to risk. My guess is most of our colleagues in Tiger are a risk junkie. I like taking on risks, not imprudently. In our mind, we can manage them.
If you ask my wife and kids, they would actually really think that you're completely wrong. But because I'm insured and I do everything to the T. I'm very meticulous and that kind of thing. I think, how you perceive risk is different. It takes time, just like training your muscles, to train your brain to evaluate risk correctly. And it takes a lot of mistakes. Initially when I was doing this, I was taking smaller risks, right? Until I became confident enough in myself to make larger bets on things that I were more confident on. When you look at it from a bird's eye view, I'm probably one of the riskiest portfolios you would see because the amount of allocation that I have to venture capital is probably unreasonable. I don't think it's particularly more risky because of the type of diligence that I did and the amount of time that I took and just being very hands-on.
You're one of the very, very lucky few people who have, both by your native intelligence, but also by the experience, and particularly, I think this is important, the training you put yourself through. You now find yourself 13 years in, really having a very different perception of risk. Now, of course, you might be right or you might be wrong, but I'm not here to suggest that you're wrong. What I'm saying is that so much of risk is in the eyes of the beholder. And I'm wondering if any one of your investments comes to mind when I say, boy, that's a risky investment. And you say, no, it isn't. And here's why. What investment comes to mind?
I'll give you two examples, one that failed and one that's so far doing okay, right? So back in the day, I did an investment in a company called Convoy, which is basically like Uber Freight. So it was for trucking, like the Uber model for trucking. We invested at a very early stage. It was like a $10 million, seed round, did a nice investment in there. And then a couple of years later, it got like a $3 billion valuation. We had a chance to sell and we did it because we thought this thing was going to become even bigger, go public. And then COVID came around. And this isn't because I was a bad investor. This is because the world is random. A lot of things can kill your investment, not just making a poor investment, like a bad idea, let's say, for example. And then COVID came around and literally killed the business and went to zero. About 4 years ago, I did an investment in a company called Figure AI, which is a humanoid robot. I don't know if you saw recently, Melania Trump had a robot at the White House. That's the robot. It's the Figure robot.
Walk down the aisle with her.
Absolutely. When we first invested, they had nothing. The founder had just a robotic hand, partially worked, and a simulation and an idea. And 10 people from Tesla and Boston Dynamics and Apple, various other, high-tech companies that had joined him to start this company. In many ways, people thought I was absolutely insane because this is pre-ChatGPT and no one was talking about AI. But I think when you're, in it and you're looking at multidisciplinary things, it was obvious that AI was on the precipice at that time. And it was an inflection point where AI could be used in the physical world to basically make robots do things that they were never able to do 10 years ago. That's kind of the insight that I had at that point. It could have been wrong, but it turned out to be so far a very right trade. Those are the types of ways that you have to think to get the asymmetrical outcomes that change the amount of wealth that you have, for example.
That company is trading or, is valued at something like 1,000 times more than when it raised capital initially. Right?
100, yeah, 100.
Only 100, sorry.
I wish it was 1,000, but it's not.
Well, if it's 100, if you were an early investor, that's pretty good. Do you have any sense of what you think has given you these, let's call it your superpower?
Anything that I've invested in, I've gone very deep in and I've had real experience with. I literally go and work at the company for like 2 weeks, whatever it may be, to kind of really learn the problem that they're solving. First of all, hard work. B, you have to be genuinely curious and have the drive to do it. Otherwise, the easier thing to do is to give it to a wealth manager and not do these types of things.
When the world tells you how brilliant you are as an entrepreneur because you just sold a business and it doesn't matter whether you're 35 or 50, you tend to think you're brighter than, let's say, you or I might think. And having that humility to say, well, maybe I mastered one thing, but I have to learn a lot more. That notion of learning, one of the things we really emphasize in our groups is lifelong learning. It sounds to me like you are a lifelong learner and approach some of these things with a certain amount of humility that no matter how much you know, you got to learn more because the world is changing so fast.
The more you invest, the more you realize you don't know, actually. And you also learn about the randomness of the world. And one of the things I also did is, I got my broker's license, even though I'd never sold any real estate in my life. I never brokered any deal. I wanted to learn real estate from that vantage point. I didn't take my Series 7, but I took a Series 7 course, right? To learn equities and bonds and how options work and these types of things. That's an essential part of this. And even if you don't do it yourself, you should know what your wealth manager is doing, right? Yeah. You should be able to manage them and have some say in it and understand what they're doing fundamentally, right?
This podcast is being recorded in April 2026. There's a war going on with Iran, obviously your homeland. Is there one investment you made, or is there anything you've done to address, protect, or benefit from what's going on in the world?
I've been a buyer, particularly of public equities. This is a temporary blip. I mean, history has shown it. It doesn't matter what the conflict is or anything like that. I mean, as a descendant of Iran, I really hope that there's a resolution and there's regime change and Iran is freed and those types of things. But as an investor, I think this is an opportunity. You can buy when everyone's afraid. If you want me to get specific, I've been buying actually BDCs that have been backing tech companies because those actually happen to be the ones that have been particularly hurt, because it's not only just the war, but there's this SaaS-mageddon going on where people are saying SaaS companies are going to be killed by AI. What's interesting in the debt of that is that their first lien and those companies are down, their stock is down 50%. They loan money at 30 to 50% on the dollar. So
yeah, it's
how much?
an amazing moment. You're picking, you got to know what's cheap and whether when the price goes down in half. We had a group once where half of the members of a group invested in a company. So the eighth member of the group invested in the company and the stock was around 20. And the week later it fell to 16. And he came in and said, "Oh my God, it came down to 16. Should I sell?" And the guy who was behind that group said to him, "If you don't know whether it's a better deal at 16 than it was at 20, you shouldn't have invested at 20. And, at the end of our meetings, we like to do a tip jar. Is there a book or a podcast, a habit or a resource, particularly on your mind right now?
Yeah. So on that learning theme that we spoke about, one of the only podcasts I really pay for is this one called The Knowledge Project by Shane Parrish. I've been a subscriber for a really long time. And in particular, he has a course that I paid for and I took during COVID, which I think would be beneficial for anybody to take for any reason. It's a decision-making course. So if you think about it, no one really teaches you how to make a good decision or what a good decision even is. All of these things, investing, life choices, they're all decisions. And some are more, let's say, consequential decisions versus inconsequential decisions. But being a good decision maker on very consequential decisions is very difficult. A lot of people don't have processes in place for this. And by the way, I thought I was a really good decision maker before I took this course, right?
Shane, I have to tell you, you're kind of blowing my mind. When you sold your businesses by accomplishment, you were about 1 in 10,000. Today, 13 years later, with all the success that you've had, you're about 1 in 100,000. And you're still saying you have more to learn in decision making. Like, where does it go?
I don't always make good decisions and I don't always do the process. That was one of the more powerful things that I had ever done. And it really helped me think about the world from a different vantage point as well.
Where can our audience follow your work? Do you ever publish anything? I know you've been on a couple other podcasts. You have such a distinctive point of view.
I have a blog on my website, shaneneman.com. I'm pretty active on LinkedIn, so I post on LinkedIn a lot.
Well, it's been fantastic to have you here. Thank you. This was what a treat. And send me a note in 5 years. Let's look at that trade.
I'll put it in my calendar.
Okay.
I will.
All the best.
Absolutely.
Thanks
so much for having me.
On our last episode, we introduced a new section of the podcast where we pull back the curtain on the conversation and go deeper into topics listeners might want to explore further. So we've gone back and re-listened to Shane's episode, and my role as interviewer will now shift to interviewee as my son Isaac puts me in the hot seat. In Shane's episode, we see the evolution from creating wealth to preserving and growing it, because Shane sold and then used that opportunity to become an extraordinary investor. That shift requires an entirely different set of disciplines. He had to re-examine and retool how he thought, how he made decisions, and how he managed risk. We created Next to study this exact paradigm, so I'm excited to talk further. Thanks for joining, Isaac. Let's get into it.
I'd love to start with this concept of reinvention that Shane brought up in the interview. It's something his parents had to do when they came to America and started fresh, and it's something that he himself had to do after his first failed venture and then again after he exited easy texting and became an investor. Was there a time in your life where you felt you really needed to reinvent yourself? Do you have guidance on what kinds of questions or practices can help during a time like that?
It's interesting. I think I've probably reinvented myself a half a dozen times because I'm somewhat of a classic serial entrepreneur. And each new venture or activity, sometimes in the nonprofit world, has required really different skill sets. One activity might be management intensive, another might be being a great negotiator, another might be taking a slower pace and letting events unfold. But I think what's most amazing, particularly about Shane, is he obviously was a gifted entrepreneur. And yet, when he stopped his entrepreneurial journey as a company owner and started becoming an investor, he's done something that maybe 1 in 10 or 1 in 50 Tiger members do, which is become an even better investor than he was an entrepreneur. I had to reinvent myself once because of a negative issue. I had had an amazing success, and my next venture was really a flop. And at the end of that second venture, I was 35 years old. And I had to say, I got to go back to what I know. So maybe that's reinventing back to the future, if you will. But the point was that I had had aspirations to be a Renaissance investor, investing in lots of different areas. But what I realized after that first failure, which fortunately came after a first success, was that I kind of knew real estate better than I knew any other area. And I had to let go of my aspirations to be a tech entrepreneur and kind of go back to where my sweet spot was. And at 37, I think I started Emmis and Company. And fortunately, it grew to be $1 billion business, and it was a phenomenal success. But I really felt like I was letting go of something and kind of reinventing myself to go back to what I really knew best. There's lots of different ways of reinvention, but I think what characterizes most successful entrepreneurs is that kind of resilience and flexibility. But in Shane's case, he really took it to an amazing extreme.
I'd love to also continue on this thread that you and Shane concluded the interview with about making good decisions, which can obviously help guide you through a period of reinvention. But this also reminded me a bit of the discussion you had with May Karwowski a few episodes back about having a hierarchy of priorities and really the privilege to consider the decisions in your life when you're managing a business and family and maybe philanthropy. Is there a framework that you use for decision making or a way that you think through and structure big changes for yourself, whether that's in a period of reinvention or even just, in the everyday throes of having to make decisions?
It's a great question, and I think we need to parse it into two really different sections. One is how do you prioritize various activities, and how do you make decisions? And for me, it's pretty simple. Family emergencies and urgencies come first. When I say an urgency, if one of my kids is in a play and it's only a one-night gig, I'll go to the play if I can in any way put whatever I'm else doing on the side. But urgencies might be a birthday party or, a playoff game, whatever that is. But after that, it's business. And third on the priority list, not life priorities, but time priority, is philanthropy. Because I always felt that in order for me to be a good philanthropist, I had to ensure the resources were available, and it's the business that created those resources. So within some normal ranking, it's family first, business second, philanthropy third. Even though the philanthropy might be really close to my heart, I just made a rule that I had to ensure that the resources would keep flowing so that I could be active philanthropically.
I think on this thread of decision making too, risk assessment really emerged as an interesting theme in the conversation with Shane and sort of how he thought about that and whether as an investor and an entrepreneur they were tuned the same way. I'm curious if you reflect on your own experience. Were there moments in your career that really helped hone your risk tolerance? I'm thinking of the moment that Shane shared about T-Mobile, being an existential threat to his business and trying to hone how he wanted to spend his time in response to that crisis. Were there risks that you often return to or remember that either you learned a good lesson from or a bad lesson from, and how have they shaped your pathway since?
Yeah, so I had almost an identical situation or analogous situation where the owner of Tiger Management, which is a huge financial institution, one of the most successful, name was Julian Robertson. In the 90s, he was revered as a god. And I think you know that there are a lot of Tiger Cubs. Those are the people who trained under Julian Robertson who've gone on to create some of the most important funds today, sued me for the name of Tiger. And I was kind of outraged because we had been up and operating for 8 years. And while I knew that Tiger Management existed, Tiger 21 was completely separate. We were actually an acronym for the Investment Group for Enhanced Results in the 21st Century. To make a long story short, they sued us, and I found out how expensive it would be to defend an intellectual property suit. And I offered a settlement. It was actually at a time when I had cancer and I needed a year to effectuate the name change, given how widely located Tiger groups were. And for whatever reason, they kind of were jerks and said, no, we'll only give you 6 months. And I had to decide, did I want to fight it or not? And I just decided, I'm going to fight it. I don't think this is right. And we did. And that was a huge risk, but it really paid off because one thing led to another. And one of their new members of their team came in, and he was just reasonable. And we settled it in a meeting, but that meeting would never have taken place if I hadn't decided not to buckle under to this overwhelming threat. And I think, in many businesses, you reach these critical moments where you have to make a decision. Really, you can only go by your gut. Hopefully, your gut is well informed by experience and wisdom. But I thought of that instant the minute he had done that. But I think the broader point that Shane was making is risk is in the eyes of the beholder. We think of risk as something that can be quantitatively measured. Yes, in securities analysis of public stocks, risk is the past volatility. But as I think I mentioned in the conversation, measuring risk by past volatility is like driving and looking in the rearview mirror instead of what's up ahead of you. So risk is clearly one of the most interesting things. And I would say many entrepreneurs are successful because they correctly assess the risk in ways that others can't. And I think that's just endemic to the game. Yes, there's some kind of systemic risk, but most of the risk is what I would call idiosyncratic, and the right entrepreneur can see through it and discount the risk because they have a better way of approaching it. And I think that's inherently what Shane was talking about.
Yeah, and he also spoke a little bit about, being overweight in venture, which might be on the face of it very risky as an investor and not necessarily as an entrepreneur, but that for him, that was the right tooling of what he understood and what risks he thought were appropriate. I'm curious about in your investing, less in your entrepreneurial activities, what are the guidelines and considerations you're focused on in terms of risk, particularly recognizing the moment that we're in globally today with heightened tensions and emerging technology disruption?
So if you think about what we're doing as a family office, you could have a conventionally diversified portfolio that would have, whether it's 10, 20, 50 different positions, and they would fit kind of the neat uh, descriptions. But as you know, we are more like a barbell, where at one end we have really high risk things, which we have high conviction for and think are going to do well. But in case we're wrong, we have more cash than would otherwise uh, really risk-free cash or gold as well. So for me, if you bring an edge or a particular skill or experience that allows you to at least hope or believe you can deliver superior returns through investing in activities that you have real knowledge about or experience. The barbell is the natural way to balance the high risk on one end with the stability that in a crisis you won't be forced to liquidate assets by having lots of liquidity and particularly cash and whatever else, Bitcoin or gold, depending on what your preference is. So the answer is most Tiger members that I can tell are risk junkies. They are attracted to risk, but on the other hand, they see risks through a very different lens than a more objective person might. And the proof is always in the pudding. If you're right and you've assessed the risk properly, it's not as risky as it seems. And if you're foolish or blind or just not very smart, you misassess the risk. That's what makes the world go round. But in simple answer, I like risks, but only the ones that I feel highly confident I can manage, and they don't feel like risks that much to me at all.
It's funny, Shane also described his investment thesis as a barbell strategy, but for him it was more also on thematics of deep tech on one end, really, out there bleeding edge technology innovation, and then on the other, physical services, consumer products, and really kind of real world ideas that are impervious to disruption on the other. I'm curious, what themes are you gravitating towards or avoiding this year, and how do you think about those categories that he laid out?
We've been focused in our venture capital investing on climate related activities. And we really haven't changed our pivot other than to realize that most of our climate investing have to do with energy. It's either energy production or energy savings. And it's not like we're trying to change the labeling to fit the zeitgeist. It actually is, if you look in our portfolio, the largest investments in our venture capital portfolio are energy related, energy production in the deep ocean, renewable energy, and almost any form of energy right now, particularly what's going on in the Gulf with Iran and oil production, any type of energy is favored in this environment. So it happens, I'm going to keep focusing on renewable energy and not focused on fossil fuels because I think the day will come before too long that people realize climate change is bad and getting worse, and we're going to be affected by it. But I do believe energy is like food. People have to eat. Well, if you want to turn on a light switch, you need energy, and anywhere in the energy domain could have extraordinary opportunity.
Thinking about the other skills that have helped you succeed and navigate the world, Shane brought up a funny exchange between the two of you around interpersonal skills and kind of the soft skills of navigating a world, particularly where hard skills are increasingly liable to be replaced by AI. Do you have any non-negotiables in terms of skills that you prioritize in people that you hire, or even that you tried to cultivate in my siblings and I bringing us up in the world?
It's interesting. My first partner when I was 25 and I would come into work every day. He was 57 at the time, and he was a salesman and one of the nicest people in the world. And he grew from a belief system that it's who you know that counts. I went to MIT and grew up in a very different environment. And I think at that point in my life, I thought it's what you know that counts. And what I learned is obviously success comes from blending the two. I learned a lot of my personal or interpersonal skills from partnering with somebody who really saw all of business as relationships. Obviously, if you're a trader sitting in front of a screen and you don't talk to anybody, your interpersonal skills are a little different or a little less critical than if you're in a business where you're interacting with people all the time. But I think the really important growth for me has been trying to hone interpersonal skills. The one thing I remember from my partner David from now 40, 50 years ago was he said, you can always say you're sorry. It doesn't cost you anything. And sometimes just admitting that you've done something wrong or saying you're sorry can make all the difference in the world. But the bottom line is I actually didn't grow up in a background where interpersonal skills, at least as I understood them, were emphasized. And I loved that Shane was teaching his kids to be likable and personable, because I do think those kind of skills may even go further in the world that's evolving before us.
Those are all the questions that I have for you today. It's been great discussing Shane's podcast. So before we finish up, I know that you always like to put some tips in the tip jar. So if there's anything you're reading, watching, or listening that you want to discuss or share with our listeners, please do so.
I just saw a show on Broadway called Proof that stars, I believe she pronounces her name Io Edeberry. You may have seen her on the show The Bear. She is an amazing actress that is coming into her own. And it was really a wonderful show. So if anybody can see it on Broadway, I really recommend it.
Awesome. Well, thanks so much for speaking with me today. It's been fun getting to play this other role on your podcast.
Thanks so much. Maybe this will become your show before too long.
If you have thoughts on this episode or want to learn more about the entrepreneur's journey, reach out to me anytime at next@muse.com. That's next@muse, MUUS.com. And if you're interested in learning more about Tiger 21, go to www.tiger21, TIGER21.com. This podcast is for informational and entertainment purposes only and does not constitute financial advice, investment guidance, or recommendations to buy or sell any asset. Neither the host, team, Tiger 21, nor their affiliates guarantee financial outcomes or the accuracy of any information provided by guests or hosts. Listeners are responsible for their own research and decisions regarding any financial matters. Additionally, companies mentioned on this podcast may be owned in whole or in part by hosts, guests, or our team members. Thanks very much.